geopolitical issues clearly raise concerns and risks and worries in people's minds, and you get a little bit of stability in that while there's still not a clear indication of where it's going. Markets have recovered significantly. So equity markets, US was up by 10, European were up by 5, Aussie lagged a bit, but it's still positive, up by 2, 3. You're moving away from the noise of the short-term concerns, and I suppose people think and speculate on the worst. It's not often that the worst case scenario happens, and so if you plan for the worst case scenario, if you sell to cash and think that the world's going to end in a pretty bad place, well, you just have all these market timing risks, and you miss what has been a very strong period of market recovery. If you look specifically at April, very short-term time frame, but there was a big rotation back into the sectors that had lagged through March. Clearly the more sensitive areas where people were concerned about valuations and the earnings outlook or the profit outlook for companies, technology sector, some of the less defensive sectors had pulled back. They were the ones that rose again very quickly because they're still seen to be the sectors that are growing the fastest. Yes, there's risks in some of those sectors, and we've spoken about AI leadership and who will be the winners in the AI arms race or the technology race. The Microsofts, the Nvidias, the Googles or Alphabets, those businesses, yes, they're spending a lot of money, but they've got amazing subscription revenues, they've got amazing recurring revenues, and they're growing from a high base. So they're still performing. There will, as we've mentioned, there will be some impacts in terms of we're not sure who the losers will be out of this. So there will be a lot of money being spent in areas where there may not be a profitable return on that money. But again, we kept talking diversification, making sure that you've got exposure to a range of different sectors, a range of different companies to be able to benefit from the winners and not have too much exposure to the losers. Diversification's working in different ways at the moment. That what you would think would be safe positions and what's historically been safe hasn't played out that way this time around. So, and maybe that's a bit of, every time it's different, and people say, that's one of the catchphrases everyone says, this time it's different. Normally they're trying to talk up something positive, but this time is a different scenario where you've had an event happen. It's generally probably going to be short term. There will be some long term effects with inflation and oil and energy prices, given the straits are still effectively closed through the Middle East. That has a long lead time in terms of that impacting inflation. But the defensive assets haven't performed as you may have expected this time around. So, and that's, I think, because there's inflation impacts and some other timing issues when you think about commodities or gold prices and what's happening with the gold market, where central banks are looking to raise some money and doing so through liquidating some of those assets. So it's an interesting dynamic. It's very difficult to know which way markets will go, and so you need to back managers that have that capability, that are willing to back the shorter term positions. But in the main, markets generally, they're long-term engines, they're long-term wealth creation or wealth preservation engines, whether it's bonds, which will give you a bit of a running yield and not much else. A little bit of protection sometimes when markets really are concerned, and equities where companies in general as a whole perform, and you'll have winners and losers in that, but within that there's clearly over the longer term improving conditions and improving outcomes and changes in leadership. So at the moment it's technology, and over time it's been resources, or it's been energy, or it's been other sectors, and it is very difficult to predict which will be the next best, but you've got to be diversified, and that's one of the key messages that we always try to focus on when we're building portfolios and thinking about how managers or how positions build into a portfolio together. having a look at the Fed funds rate, it hasn't moved, and the markets are suggesting it's not likely to move in the next handful of months. And that's probably a little bit of tension between the politics of the situation and the actual fundamentals of the economy over there. US economy is actually performing relatively strongly, and there has been some beneficiaries from higher oil prices. They're generally an oil exporter or an energy exporter now, compared with where they were maybe a decade or 15 or 20 years ago. So that's played positively for the economy there, and there's still tension or challenges in some parts of the economy there, but generally the economy is performing relatively robustly. Inflation's semi under control, and the energy price piece will be interesting to watch to understand how much impact that does have on inflation for the consumer in the US. But generally the economy is performing well, and inflation's relatively under control. So the outlook for rates there is relatively stable. Here's a different picture, and so we've had government spending and a better outcome in the private sector in terms of performance and recovery, and so inflation here is still something that's being challenged and something the central bank's very actively monitoring and moving on where they need to. So we have had another cash rate rise just this week. And still likely, I think, in many economists' views, that there may still be a bit more to go, which is interesting given oil prices and energy prices are out of their control and are a bit of a handbrake on spending and growth, if you like. Bond yields have been relatively stable over the last month. And that's, I think, markets trying to adjust to understanding what the inflation outlook is over the longer term. So how much of a longer term impact this energy issue and probably the second and third order effects with other fertilizer prices and other inputs, which will really not play out probably for 6 or 12 months. Because farmers don't plant crops every week, they don't need fertilizer every week, but when there is a cut in supply, which there has been, that's going to be something that will take a little bit of time to play through, and then impacting economies with higher inflation potentially for food prices as that comes through over probably 6 or 12 months. It has been relatively stable through this period, so and that is the interest rate differential kicking through. So rates here are higher in the short-term sense; they're expected to be higher in the long-term sense. That's our inflation issues that the economy is trying to deal with, which is leading to support for the Aussie dollar. That there's a bit more demand for it because of those differences in interest rates here versus overseas. Commodity prices have also been relatively robust as well, so that's also a positive for the Aussie dollar as well, as more demand for the output. On the outlook, the geopolitical issues haven't gone away. That'll be something that we'll still continue to watch and hopefully see some sort of positive resolution. The opening of the straits there is a really important factor that we need to monitor and be aware of in terms of where that goes, because that is the inflation catalyst at the moment. And then as we hit through May, we've got reporting season in the US starting to be a bit more active. So we'll be monitoring for a bit of volatility in company prices in the US and what that means for what companies are saying about the outlook and how they're juggling what's going on in the economy and in the globe at the moment. And then that'll hit into probably June, July for Australia, with reporting season a bit more active through that part of the year as companies start to report their end of financial year results, but still a couple of months away for that.